Ever felt like someone's spying on you from behind your back? You buy, and suddenly the market goes down. You sell, and just like magic, the market goes up. That's because, more often than not, retail traders find themselves getting tricked by market makers. Imagine this: the market seems to be going down, with sellers in charge. It's a downward trend, and nobody wants to buy when the market is going down. But here's where it gets sneaky. Suddenly, the market makers decide to push the market up, breaking through a level of resistance where it usually stops going higher. It looks like a new upward trend is starting, so retail traders start buying, thinking it's a good time to get in. But guess what? It's a trap set by the market makers. They sell their shares while everyone else is buying, making a profit. Then, just as fast as it went up, the market drops back down, leaving retail traders stuck with their orders. In this video, I'll explain how market makers can trick you in trading and share our strategy to avoid falling into their traps and make profits instead. If you're interested, please subscribe to our YouTube channel and turn on notifications to know when we post new videos. Before we delve into the market maker's trading setup, there are two critical principles that you need to deeply understand: trends and false breakouts. Let's begin with trends. In a downtrend, the market forms lower highs and lower lows. However, the challenge is that the market movement is often choppy and not as clear-cut. Now, let me ask you, are we still in a downtrend? The answer is yes. We are still in a downtrend until we get a candle to break and close above this lower high. Look at what happened next. As you can see, after the breakout of this lower high, we can see that we are no longer in a downtrend and a new uptrend is likely to form. Let's apply this concept to another chart. Here we have an uptrend with 1, 2, and 3 moves. According to what we said earlier, we are in an uptrend as long as we stay above this low. In the next moves, the price broke the structure level to the upside and made a new higher high. So this is our new higher low. And once again, as long as we stay above this level, we are in an uptrend, and the market continues to make higher highs and higher lows until we get a break and close below the previous higher low. After that, we are no longer in an uptrend, and it may start a possible downtrend. Now that you understand the basics of trends and market structure, let's discuss false breakouts. A false breakout happens when the price breaks out of a chart pattern, but then quickly moves back inside it, failing to sustain the breakout. Imagine we're in a downtrend and the market breaks support downward. When the market retraces to this level, we expect it to act as resistance and push the price back down. However, if it breaks through without hesitation, that's a false breakout. Imagine we're in an uptrend and the market breaks resistance upward. When the market retraces to this level, we expect it to act as support and push the price back up. However, if it breaks through without hesitation, that's a false breakout. False breakouts show momentum in the opposite direction and can signal a potential change in direction. Now that you know all the concepts required for the market maker's trading setup, let's jump into it. So once again, imagine that we are in a downtrend. The market makers want to push the market from this level down to this level. Let's suppose they want to sell 10 million shares before reaching this lower level. But here's the challenge: everyone knows we are in a downtrend, and the price is more likely to fall. Everybody is looking to sell, and no one wants to buy. So this is how they make people buy their shares with a simple trick. They will create a consolidation area and break it to the upside. Many people think that the downtrend is over and the market will reverse. They enter long positions thinking the price will go up from here. However, the market makers use this opportunity to sell into these long positions, grabbing all the liquidity they need, and then push the market back down in line with the overall downtrend. This strategy helps market makers execute their large orders without causing a drastic price movement against their intended direction. This is how we approach this market for a sell opportunity. When the price retraces back to this consolidation area, it gives us a selling opportunity. We will enter a sell position with our stop loss protected above this level and target the next level of structure to the downside. Let's summarize our approach in 2 steps. First, we have identified that this is a downtrend until we get a break and close above this lower high. So we have a bearish overall bias. Second, we have noticed this false breakout that could be a signal of a possible trend change for a short-term uptrend. We will execute a short trade when we get a break and close back below this consolidation area. This strategy allows us to take advantage of selling opportunities within the context of the overall downtrend. Now, let me give you another chart example. We can see a clear downtrend with lower lows and lower highs. This signals a bearish bias, and will be on the lookout for opportunities to enter short positions. Next, we notice a false breakout where the market breaks above a consolidation area and then quickly returns to it. This suggests selling pressure and hints at a possible short-term reversal or uptrend. In response, we'll consider placing a short trade after the candle closes below the consolidation area, setting our stop loss just above the recent swing high. Let's explore another example in a bullish scenario. First, you identify a moving uptrend where you spot those higher highs and higher lows. As long as the price doesn't break and close lower than the last higher low, you confirm you're still in an uptrend. Next, you're on the lookout for potential buying opportunities. You observe how the market forms a consolidation area and then breaks it downward. Many traders then jump in with short trades, thinking the market will continue downward. However, the price surprises everyone by returning to the consolidation area, ignoring the previous support turned resistance. This situation creates a false breakout, which is your cue to take action. You patiently wait for a candle to break and close back inside the consolidation area, marking your entry point. Your stop loss is set just below the area for protection. Here are 2 handy tips for managing your trade. First, consider closing half of your position when the price hits your initial target, and for the rest, keep an eye on your profit. Overall, you're banking on the likelihood of reaching your target being higher than the trend reversing entirely. This strategy aims to help you capitalize on false breakouts within the context of an ongoing uptrend. I hope this video provided you with some value. If you enjoyed it, please smash the like button and subscribe to stay updated with more content like this. Your support means a lot, and I look forward to seeing you in the next video.